The technology index for the year is up substantially. That's in the double digits. And right behind it, other indexes are doing extremely well for the year. The Dow Jones and the S&P 500, all north of 12-13%. And the reason I'm bringing that to the discussion this morning is because with that in mind, we also need to be cautiously optimistic about the future and start asking the tough questions. How much further the market can keep going up? Because the moment the risk reward turns against the investor, that is the moment I think we all need to be a lot more defensive in nature. And I'm not so sure that the risk reward going forward, in my view, is so attractive. After seeing one of the best years since the beginning of the year in the past 20 years or so, asking 148 professional money managers how they see the future looking like. And one interesting point was that a lot of them said that for the year they expect an increase from this point onward of anywhere between 1 to 5% going into 2019. And on the other hand, the bears in the marketplace were indicating about 12 to 14% downdraft for the market. So if this is any indication of the risk reward we should be expecting, I would say doesn't look that attractive. A downside of 12 to 14% as opposed to an upside of anywhere between 1 to 5%. We are fundamental investors. We look at things longer term. So we are not necessarily always looking for the next market correction. And I do call it a market correction because all in all, the economy is looking pretty strong. We got good numbers last week on the GDP in this country, which came out at 3.2% growth rate. That is a lot less than the 4.2% we saw in the second and the third quarter of 2018, but nevertheless, we are still growing very nicely, a lot more than the 1% in prior years. Corporate earnings are not coming as negatively so far, and a lot of these money managers that took a part in that polling actually indicated that they think that corporate earnings are going to be anywhere between 1 to up 5% for the year. And we have one of the strongest employment numbers in a half a century, whereby consumers are actually seeing some sort of a wage growth. The labor force is growing at about 5%, and the wages are growing at about 5%. And don't forget for a second that in this country, 68% of all consumption is done by what the people in this country are spending their money on. So these are all good numbers. 65% of these money managers are buying communication services companies, 78% of them are buying healthcare companies, and 74% of them are buying information technology companies. 72% of them are buying Apple computers. I always like to see a wall of worry before jumping in. Fundamentally, Apple looks very strong. Other data points that I thought of sharing with you is that 49% of these managers are bullish. This is one of the lowest numbers of bullishness in the marketplace, because normally you see north of 50%. So some of them are becoming more defensive. 70% of them are thinking that the market is fairly valued. And 28% of them are thinking that the next shoe to drop will be some sort of an economic slowdown / recession. Being cautiously optimistic and defensive in nature at this stage of the game is not a bad thing.
Okay, so today I'm going to talk about the streaming service space. Spotify recently has, in some way, shape, or form, gone public. There are stipulations around that, but they've made a big splash. There's also a few other services like Tidal, owned by Jay-Z, and then we know Apple jumped into the space, which brought in a lot of competition as well as interest that this is actually a viable space. The most recent is Amazon, is gearing up to launch a hi-fi music streaming service. I'll highlight Spotify. They are currently the largest streaming service, and they have 100 million monthly active users who are paying for their subscription service. 217 million of those are subscribers. So they have a premium version and then they have a free version. So they operate under the freemium model. They operate in 79 different markets. Most recently in February, they launched into India, which gave them a huge increase. This last year, they did 1.68 billion in revenue. They're still not profitable. They're at about negative 88 cents per share EPS. They're losses are narrowing, so they gained about 17 million euros in profit last year. They are closing that gap, which makes them even more interesting. For next quarter, Spotify, they expect the monthly active users to be between 222 and 228 million users. So that's up about 23 to 27% year over year. Their premium subscription service will be between 107 to 110 million dollars that they estimate, and that's up about, in their forecast, 29 to 34% year over year. For next quarter, they also estimate revenues at 1.5 to 1.71 billion euros, and that's up about 18 to 35%. Gross margin, they estimate to be between 23.5 and 25.5%, and only having an operating loss estimated between 15 to 95 million euros, again, closing that gap. So Spotify, they may not yet be profitable, but they're definitely someone we want to look out for, and definitely this is a space that we're interested in because Apple is certainly a buy for us.
Talking about some of these technology names and how they trade and what multiples they trade, a lot of them don't make any money. A good example is a company that came as an IPO last week, Zoom. I think was priced at about $30 a share, trading today at 64. Operates on a subscription model. My point is that a company that sells at 60 times revenues sounds to me a bit out of whack. It doesn't matter how good and fun it is for individuals to use their service. I think they do about $300 million in sales. Unless they start moving into new markets and keep growing at north of 40, 50% a year, someone one day will have to deal with this stock going down.
Okay, so again, let's talk briefly on the yield curve. The 3 to the 5 year, the spread on that widened a little more last week to 3 to 4 basis points. I was reading an article in Barron's about the 2 to the 10 year, which is the main gauge that we want to look at. That had gotten as wide as 261 basis points back in 2013. So there was a nice, about a 2.6% spread between the 2 year and the 10 year. That got as low as 12 basis points recently, and it's starting to widen. And last week it was anywhere from 21 to 23% on a regular basis. So the fact that it went to that narrowing and that started to widen, part of this article read that regardless of the reason, the investment implications of a widening yield curve are bullish for equities. Stocks usually will perform well under these conditions. So although it's not the only indicator that we're looking at, the fact that the yield curve is widening between the 2 year and the 10 year looks like good news.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. If you like the content, please subscribe to our video channel. The highlight of the week is that at times, bulls make money, bears make money, and pigs get slaughtered. It's okay occasionally to become defensive in nature when investing your hard-earned money.